All right, guys, welcome to another episode of the Highline Podcast. Very excited to showcase a new market today, which I'm sure you probably haven't heard of, which is the global vehicle subscription market. A vehicle subscription service is where a customer pays a recurring monthly fee for a subscription to one or more cars. Usually, the subscription service covers car insurance, registration, maintenance, and repairs of the subscribed vehicle. This works like any other subscription where you are renting the item and you would have to pay for the monthly subscription fee plus the fuel or electricity if it is an EV. The vehicle subscription market size is currently valued at 3.8 billion and is predicted to grow to 172.4 billion by 2029. Yep, that is correct, which is a calculated annual growth rate of 74.3% per year. This is definitely the fastest growing market on the podcast that we have studied. If you operate in the car industry or if you have an interest in the car industry, if you're a dealership, if you provide rental services to any type of equipment, or you are a financial provider, you need to be paying attention to the market growth of vehicle subscription services so that you can position yourself to capture in this market demand. I think this trend is going to cross over to all types of equipment, whether that be heavy machinery, whether it be motorbikes, or some other type of expensive consumable item that you can rent via subscription. I think it's all going to be bundled into one market eventually. Today, we're going to be looking at why the growth is occurring, how COVID significantly impacted the industry, where the value is for a vehicle provider, what are the major markets, and who are the major companies operating in this market. And then we're going to finish off with some of my key takeaways and our ideas. What I want you to get out of today's podcast is the ability to start to uncover good positioning in a market trend. I'm going to see a very good example of Onto's positioning in this market, who is an electric vehicle subscription service provider. They have two major tailwinds behind them. The other thing I want you to start to recognize is when incumbent companies try and enter an area and then fail, we need to understand why they have failed and know that they are going to be gun shy about re-entering the market. We need to be paying attention to see if the fundamentals of the market have changed, and we need to know why they have changed, because that will tell us whether or not it is the right timing for our idea. This gives us a huge advantage because the incumbent companies have already tried and failed. Let's start off today's discussion by talking about where is the gap for vehicle subscription services in relation to car mobility options. In number one spot, we have having your own car. In number two, we have renting a car for a short period of time. In number three, we have car sharing or ride sharing, which offer maximum flexibility for short-term mobility. And then we have public transport as the last and final factor in our mobility. Ride sharing and car sharing offer maximum flexibility for short-term use, but are too expensive for long-term use. There is a clear gap between renting a car and rideshare. Car rentals are often designed to be very short-term and are very expensive to use for a long period of time. Their incentives are for you to rent a car for a couple of days or a couple of weeks. Where the gap between buying a car and renting a car is where vehicle subscription services come in, looking at that longer term rental piece. Vehicle subscription services can be up to 12 months, and the most popular segment at the moment is a 6 to 12 month lease. COVID is the significant contributor to the market growth of vehicle subscription services. And I'm noticing a common pattern. In last week, we saw both Whoop and Quora's business transform to the next level due to the impacts of COVID-19. So whenever we see these massive periods of change, they come with huge opportunity. What happened to the automakers is they witnessed a huge drop in revenues as consumers became fearful of the future market conditions and stopped purchasing a new car. Additionally, there were very disrupted supply chains for microchips and other critical parts which still exist in 2023. The adoption of vehicle subscription services during COVID absolutely boomed because no one wanted to take public transport due to COVID concerns. Rideshare was a high risk because the driver might have had hundreds of passengers in that car. These factors contributed to a major adoption of vehicle subscription services, and the market growth has still continued on post-COVID, which is very rare actually. In Europe, it's predicted that by 2025, 10% of all new car registrations are going to be vehicle subscription services. Startups are capitalizing on this opportunity, developing intelligent digital platforms for fleet management And there are a few companies who are heavily backed by venture capital and are trying to capture as much of this market as possible from OEMs. OEMs are the companies that produce cars: Toyota, Mercedes, Mitsubishi. The psychology behind car subscription growth is a broader trend that I've been witnessing in society. And I think we're going to see this over and over again in our studying of high growth markets. And I want to read you a quote by Josh Wolf, who is the general partner of Lux Capital, who describes this trend perfectly. My dad's generation was about ownership. Even my wife has the nesting instinct. You have to own. You want an apartment, you want your own car. The younger millennials today, it is an anchor item for them. It's not freedom. What they want is the ability to press a button and have access. They want a call option. It's cool and desirable that you don't necessarily have an apartment, you rent it. Maybe you rent a different apartment because you have multiple jobs. Imagine if you could rent all of this expensive jewelry for a bespoke event for a one-time thing. The access economy is an underlying trend that is going to disrupt a number of industries who are predicated on the ownership economy. That describes a broader trend that I've been seeing in Generation Z. Cars have lost a lot of their status symbol, not just for millennials, but I think the major driver is just the cost of them is just outrageous. The cost of living in a lot of different areas, particularly in Australia, is high. It's already going up. We're in a world where consumers are consistently changing their life circumstances, and they are starting to see car financing as a burden rather than a benefit. The other factors which enabled car subscription services to increase popularity is one, high-speed infrastructure. That has allowed you to order a car using your smartphone and get it delivered to your house. The other major driver is the rising cost of vehicle ownership and shifting consumer preference from ownership to usership. In the US, the cost to own and operate a new car is stood to be around $11,000 in 2022, which is a rise of 11% since the year before. Other factors like the rising cost of fuel due to the ongoing global wars and the impact of inflation on the consumer's dollar, these are all different factors which are making owning a vehicle and buying a new vehicle very expensive. And we are very close to vehicle subscription services eventually becoming cheaper than a car in general. The more fuel prices rise, the more inflation rips, the better this alternative is going to be, and the more cost competitive vehicle subscription services become. And that'll be the key turning point to making this market go absolutely nuts. We've spoken about the benefit to consumers, but now let's take a look at what the benefit is to an OEM or a car dealer. So for an OEM, and we're going to use Mercedes as an example. This is a luxury car brand. They retail for high prices. They're known to have good quality. And for a young person, even if you have a high disposable income, you're probably not going to be able to go and buy a new Mercedes. But with the vehicle subscription option, this might allow Mercedes to create a new price point that brings younger people into the brand earlier. And if they have a good experience with the brand, they might end up being a Mercedes customer for the next 40 years. Would that increase the lifetime value of the brand? And that is an important benefit that OEMs can explore using the vehicle subscription market, is being able to create an alternative revenue model to attract the next generation of customers to their brand. In terms of the benefit of car subscription for a dealer, how a dealership operates is they'll buy a fleet of cars and the dealership has to service those vehicles that they sell. And in most cases, they provide a loan car to a customer when their car is being serviced. These cars are often new and they don't go and sell on the floor. And these are called service loaners. So the subscription service allows dealers to take retired service loaners and use them for the subscription fleet. Dealers have to carry service loaners and they try and rotate them out of the service loaners into the used car fleet as quick as possible because they're a drag on the balance sheet. But because service loan cars are still relatively new, they can't write them down a whole lot. So they struggle to sell them because they're used, but they're only slightly less expensive than a brand new car that has done no kilometers. The vehicle subscription service allows the dealer to continue to write down this vehicle, which means you can price it significantly lower for the retail buyer, which means they can sell it a lot faster. And they're also creating revenue while you're doing it. So it's a complete no-brainer for a dealership to start to begin to utilize this service for their service loan cars. Now let's take a look at the car subscription stack. There are many moving parts in the car subscription stack. And it's quite a fragmented market. What I mean by that is you've got things such as asset utilization. The burden of subscription services is you have to carry a hard asset like cars on your balance sheet. For example, a dealership that might be utilizing vehicle subscription services, it's important for them to know the happy medium between short term vehicle deployment and long term commitments with lease agreements because they have to identify the depreciation of that vehicle and they don't want to hold the vehicle on their balance sheet for too long. So, the first part of the stack is asset utilization. Then we have digital sales and customer engagement. Remember who the customer is. It's millennials and Gen Z, and they are not used to dealing with salespeople. They prefer to do things online via an application. So there is opportunities for startups to create digital sales and customer engagement platforms specifically designed for dealerships to bring on car subscription services as a new option. Then we have the operations and logistics. How do you source the vehicles? How do you maintain them? How do you deliver them to customers? How do you pick them up? We have the asset sourcing, the remarketing, and the risk management. How do you ensure that people don't trash these cars and what happens when there is a crash? And then we have the funding and financing around these. These finances will be purchased on debt. And I think that is one of the biggest opportunities for financiers who are outside of the car market to start looking at providing tailored financial services to dealerships to allow them to buy a subscription fleet. There are a couple of factors which are not so good for the car subscription market. In the past 5 years, there have been no fewer than 10 automakers which have started a subscription service and shut them down. And a number of startups have came and went. At the moment, car subscription services are still quite cost prohibitive. On average, it costs about $1,000 per month for a subscription. That's $12,000 a year. You can definitely buy a secondhand car for that price, and you could potentially put a deposit down for a brand new vehicle. That is going to be the real challenges that subscription services are going to have to battle with. They're going to have to make it significantly cheaper to make renting the vehicle the primary choice rather than buying it. Let's take a look at some of the existing OEMs who have tried to start a vehicle subscription service and ended up failing. Automakers like Lexus, BMW, Mercedes-Benz, and Audi tried to start vehicle subscription services. However, they couldn't grow them beyond a few cities due to a lack of customer demand and the limited capacity of the vendors that were managing the vehicle fleets and services. What they're saying here is their market timing was off. They were way too early and they thought it was going to be easy and they didn't anticipate how they were actually going to roll this out into their existing operations. This is a golden light for us. This is showing us that their market timing was off. OEMs are going to be very hesitant to re-enter the market. And the reason why that is because they already tried it and it failed. So everyone in the boardroom is going to say, oh, you already tried this before. It didn't work then. It's not going to work now. Blah, blah, blah. All this bullshit, which is going to leave huge opportunities for startups while they are arguing in the boardroom to come in and collect that market. The other thing which is loaded in that sentence is they were saying that the vendors didn't have enough time to manage a vehicle subscription service fleet because they were too busy with their own operations, which shows us the amount of opportunity available here for startups to work with those companies and offer vehicle subscription services. While we're on this point, there is another key learning which has come to my mind, and that is if we see incumbent companies like OEMs and car manufacturers who have tried to enter a market that we are thinking about and they've failed, we need to be paying close attention because it shows that they saw what we saw and they tried to do it, but it didn't work. And we need to double click and zoom in to understand why it didn't work and what has changed. If we are going to pursue these opportunities, what has changed now? And we need to be experts in understanding that change and realize where the opportunities are. And we need to be able to explain this to investors so that we are 100% confident in our judgment that the market timing for our new idea is right now. The other thing we need to learn is incumbents are going to be so gun shy about re-entering this market. While they are still arguing in the boardroom, this is going to give us time. By the time they have figured out that this is a thing, it's already too late because we are too far ahead. We've already figured out all of the kinks in our armor, and now we are just rinsing and repeating and hopefully making bank. All right, let's shift gears a little bit and take a look at some of the companies operating in this market. The first company we're going to take a look at is a company called Finn. Finn was founded in 2019 out of Munich in Germany. The company originally started providing car rental subscription services to consumers, but found the overhead to be a nightmare. They trialed a B2B rental subscription service in Munich. They found that to be successful. They doubled down on that strategy. Fin targets small to medium-sized businesses with fleet sizes of 15 to 100 vehicles, which they believe is underserved by the current car service rental market. This is an interesting niche within the rental service market, and they've obviously found a very good window here, which they've capitalized on using this car subscription services and the longer term rentals. The company said it has 2,000 cars, trucks, and SUVs on the ground in the US alone, as well as a large number of electric vehicles. And in 2022, they are on track to grow their subscriber base to 30,000. If we just do a quick calculation here, if each car costs $300 per month, that's $3,600 per year, times by 30,000, that's $108 million a year in annual recurring revenue, which is very impressive. So if these numbers are correct and this is true, it was only founded 4 years ago, and if they're doing $108 million in ARR, that is like crazy venture capital growth. If the market size grows at 74% year on year, then Fin is going to capture a large part of the B2B subscription base. Now let's take a look at a company that operates specifically in the electric car subscription market, and that company is called Onto. They were founded by Rob Jolly and Danahan Omiche in 2018, and they strictly provide electric vehicles. They operate in the UK. They also offer a range of different electric cars, including Renault, Peugeot, Volkswagen, Audi, Tesla. Their subscription services start at €400 per month. They currently have over 7,000 electric cars. That's really impressive. And they've grown reportedly in 2021 by 500%. In 2022, Onto raised €60 million and then secured another €100 million loan in 2023. Onto has extremely good positioning in this market. This is a good learning for us here, because what it's showing us is this market, car subscription services, is growing exceptionally fast. And Onto is also part of the broader electric vehicle push towards net zero trend, which means fast-growing market, large underlying societal trend. This is what we're going to call a bullseye from now on, because this is exactly what massive opportunities look like. When fast-growing markets meet larger societal trends, you can start huge companies. Moving on to a company that enables dealerships to roll out subscription services called Loopit. Loopit was founded by brothers Paul and Michael Higgins in 2016, and they founded an online car company called Hello Cars, which was a fully online used car dealership. I just want to pause here and review a concept that we looked at in last week's podcast, which was the efficiency hypothesis score. And if we apply the efficiency hypothesis to online car dealerships, it's very clear that it doesn't work. And the reason why it doesn't work is because buying a car online, a used car online, is not actually more efficient than going to a dealership in person, viewing the car, inspecting the car, driving the car, checking the brakes, talking to the salesperson. It is not effective to do that via the web. And that's one of the reasons why I believe that online used car dealerships have never taken off, because they're not more efficient. The brothers realized this, and they pivoted into providing a vehicle subscription service enablement platform. They allow car makers, car dealerships, fleet rental companies, and startups to offer a car subscription service to their customers without having to build their own software layer. When the brothers launched their product, they quickly got traction in New Zealand during the pandemic, and then quickly expanded to the UK. As we know, Europe is the major market for vehicle subscription services at the moment. The brothers have a fantastic business here, because they're providing a software layer to a very asset-heavy business without having to own any of the vehicles themselves. If you think about it, Uber is the biggest taxi company in the world, but doesn't own a single taxi. They just provide the software. This is a similar sort of business model here, which allows them to build very strong margins and probably generate a lot of cash flow. I think Loopit is the major company here to enable other existing rental services companies to roll out vehicle subscription services. And this is a good example of a very good opportunity in a market that is very asset heavy. So we don't necessarily want to be the provider. We might just want to be one small piece of the larger market, and that might just be a software company. That allows us to focus on the delivery of our software to make things a bit simpler. I'm going to move on to my key takeaways. We've spoken a lot about tailwinds, but again, it's just worth reiterating. We want to be looking for at least one tailwind And car subscription services has two major driving tailwinds behind it. The first being the push towards electric vehicles. And the benefit of that is because electric vehicles are still quite expensive due to a lot of mineral shortages, and that is predicted to continue on for a while. There is a wedge here in the market between buying an EV, which is still very expensive, and then getting rid of your petrol car. And vehicle subscription services provide the wedge in the middle. The other key tailwind behind this market is the rent versus ownership economy, which we've spoken a lot about Gen Z and the millennials preferring to rent things rather than buy them outright. And that is a trend that has driven the vehicle subscription market growth. The other thing that I like about this market is it is hard for an OEM to start a vehicle subscription service. It is hard for a dealership to start a vehicle subscription service. There are many moving parts. It's highly fragmented, which means the technical complexity of starting one of these companies is not easy. To add to that, you need to raise a lot of money, and it's very capital intensive, which means the barrier to entry in this market is very high. And that stops us from having a lot of competition. If we have too much competition in the market because it's easy, then the price is going to be driven down and your margins are going to be eroded. So that is one of the positives. It is hard and it is expensive to operate. The last major takeaway for us is fragmentation breeds opportunities for startups. I have a theory, and that is fragmentation in high growth markets leads to excellent opportunities to create vertical market companies. And what I mean by that is if we look at the car subscription service market, within this market, we have different parts of the stack. We have vehicle optimization, we have financing, sales and marketing, relationship management, payments, collections, returns, service and repairs. As the market grows, these areas are also going to grow. And there are opportunities for startups to create specific services targeting one of the different parts of the stack. For example, you create a software only targeting vehicle optimization for car subscription services, or you create a service only providing financing for vehicle subscription service companies. Vertical market companies are some of the best companies to start because they're very niche. And if you become the market leader in that niche, everyone in the market, because it's small, uses your services. They have low churn and high stickiness. And the reason why is because they're often mission critical. For example, you build the software that is responsible for managing the vehicle optimization and depreciation of a vehicle subscription service fleet. That is pretty critical to how you operate your vehicle subscription service. It's unlikely that you're going to change from that service if it's already working, your processes and your people are trained in how it works. It's unlikely that you're going to entertain the threat of leaving. And we've already seen Looper looking at the enablement piece. That is why it's very important for us to understand the different parts of the stack early. And we need to understand which areas of the stack grow as the market grows and which ones are growing the most, because those are really good opportunities. The last idea that I'll leave you with is asking what are the types of long-term subscription services could you provide with hard assets like trucks, vehicles, mine site cars, motorbikes, boats potentially, and see if you could tap into the existing market demand of vehicle subscription services. Wrapping up today, we've covered how COVID was a significant factor in growing vehicle subscription services. We looked at some of the downsides of vehicle subscription services due to their cost. We also have a good understanding of what it looks like to capitalize on opportunities when incumbent companies have already tried something in this market. We also have a good example of what it looks like to capitalize on opportunities when an incumbent company has already tried something in the market but has failed because they were too early. We need to understand what the fundamentals of the market are and how they have changed. We need to be able to test our thesis and communicate this, because the answers to those questions will allow us to understand if our timing is right for our idea. Lastly, we've taken a look at the different parts of the stack, as well as discussed some of the more interesting companies in the market. That's all for this week's episode. I'll chat to you again next week.